Good evening, everyone. Can you hear me?
Yes, we can.
Okay. Good evening, everyone. I'm Scarlett. I'm Senior Account Manager from TMGM Sydney, and I'm very delighted to be tonight's host. And thank you all for joining us tonight. We are very excited to share some valuable insights with you tonight. Firstly, let me give you a brief introduction of TMGM. TMGM is one of the world's leading CFD trading platform. We are trusted by traders across 200 regions worldwide and provide over 100 trading products for investors and institutional clients globally. In the past Q2, our monthly trading volume exceeds 820 billion US dollars. We now have 5 offices worldwide: Sydney, Melbourne, Adelaide, Canberra, and Cyprus. We focus on delivering innovative technologies, strong security, and a client-first approach. TMGM was founded in Sydney, Australia in 2030. In the early years, we focused on building a strong foundation. In terms of operation, TMGM formed a partnership with LifeBet, an Australian fintech company specializing in enhancing financial operations. In terms of compliance, we gained ISIC Certificate Financial Service License, and we had Dr. David Mullen, Professor of Department of Law at Macquarie University, to become our board member. Well, this helped us to gain the trust of our first clients. As we expanded, we add more trading products and enter new markets across Asia Pacific regions. In 2018, Melbourne, Philippines, Adelaide office were established in Australia. And in 2019, we launched the Taiwan office and acquired the Vanuatu license. It's a milestone of TMGM's journey of becoming a global platform. We had more than 100,000 clients, and our monthly trading volume exceeded 100 billion US dollars. In 2020, we strengthened our presence by forming partnership with leading institutions such as Australia Open. And in 2021, we sponsored several world-class sports stars and reached a milestone of trading volume exceed 190 billion US dollars. And we also acquired the New Zealand license issued by Financial Markets Authority in New Zealand. Well, these collaborations enhanced our credibility and improved the trading conditions and helped us to reach wider audiences. In 2022, TMGM continued to strengthen our presence in Thailand, and we sponsored several very important events, such as the FAIR project to protect Great Barrier Reef, and we sponsored the Hurun Australia and the AFF Cups. In 2023, we proudly sponsored Jay Chou's World Tour concert and became the official partner of Chelsea Football Club. At that time, our monthly trading volume reached the new high of 349 billion US dollars, ranking third globally with 11 consecutive quarters for growth. In 2024, TMGM continued our partnership with Chelsea Football Club, and we continue to sponsor Jay Chou's World Concert and become the gold sponsor of the Yunshe Sydney Show. And our monthly trading volume surpassed to a new level, like 543 billion US dollars, ranking second globally, and we consistently among the top 5 brokers. At that time, we were also awarded titles such as Best Forex Trading Platform and the Most Trusted Broker globally. Well, with years of consistent efforts, in year 2025, our Q1 monthly trading volume reached 525 billion US dollars. And as we introduced before, our past Q2 monthly trading volume exceeded 820 billion US dollars, representing a rapid growth over 50%. And we have more major sponsorship on the way. Currently, TMGM operates under 3 major licenses: ASIC from Australia, VFFC from Vanuatu, and FSC from Mauritius. Well, this license reflects our strong commitment to compliance, transparency, and protection of our global clients. We also provide a wide variety of investment products, including Forex, precious metal, energies, indices, cryptocurrencies, which Mr. Yong will cover shortly, and US and Hong Kong stocks. Well, this diversity allows our clients to explore investment opportunity globally, and they can also manage risk across different asset classes. About our trading advantage, we have trading center provide with trading insights and analyst views to help our clients with better trading decision. And we also provide a low-cost, high-quality trading environment and support our clients with 24 hours per day, 7 days per week customer service. Well, TMGM is not only about trading. We are very committed to social responsibilities. In 2022 to 2023, in the Sapphire Dinner, TMGM partnered with Great Barrier Reef Foundation to protect marine life, engage in social responsibilities, and promote sustainability. But looking ahead, our vision is very clear: to empower traders globally with innovative tools, reliable support, and access to diverse market. We focus on combined professionalism with responsibility to create long-term value for our clients and society. Well, let me introduce the special promotion for the webinar today. If you registered from the webinar's link and deposit more than $250, we will have one entry to the lucky draw promotion. Well, the more you deposit, the more entries you will have, and therefore the higher chance of winning. And one lucky winner will have Brooklyn Net Macau game tickets, and one lucky winner will have Blackpink World Tour tickets. We also provide a $100 cashback voucher and a $50 cashback voucher. Well, eligible clients will automatically into this draw as long as you register and deposit by the end of this month. Well, that concludes my part of introduction, and it's my honor to introduce today's speaker, Mr. Anka Yang, who was awarded the most popular trainer of Forex in APAC, and today he will share his 3 steps to win in crypto trading and conduct a live market analysis followed by a Q&A session. Let's warmly welcome Mr. Yang to begin his session.
All right. Okay. Good evening, everyone. So just a quick check. Yeah. Okay. So I hope you guys are able to see the screen. Should be fine and all working. So as mentioned, right, today's topic over here will be sharing with you guys the 3 steps, or I would call it a framework, to approach crypto trading. And of course, today, if you trade beyond the cryptocurrency markets, if you look into currencies, if you look into indices, if you look into stocks, essentially, this framework can be applied as well, right? But of course, it's even more important to have a proper step and framework if you're approaching crypto markets, which is very, very volatile, even in the recent months, right? So with that said, let's just start off with understanding, what are some of the common struggles and challenges that traders would face in trading, and how can the framework provide you guys some clarity, a proper steps, or say a system to help you approach the market with confidence, right? As we progress in today's session, of course, some of you may have questions as well. Do put it into the Q&A tab, right? So that at the end of it, we'll do have a Q&A segment, and I'll do my very best to answer as many questions as we can throughout the sessions, right? So what are some of the common challenges that traders face, right? Over here, I list down quite a few. Includes, of course, the emotional aspect, the trading psychology component. More specifically in crypto side of things, FOMO is going to be predominantly there, okay? Why? Because the nature of how crypto market works oftentimes is that it will be in a consolidation. You'll be like stuck in the range. And then there will be some events that drive it, and then suddenly the price starts to shoot up, right? And then traders in general is where they're gonna feel emotionally kind of like, did I miss that move? And then they jump in at the very, very top, or the very, very bottom, in terms of like selling it, and then the market starts to U-turn. Okay. Now, for those of you who are aware, just like 2 months ago, we have Bitcoin hitting the headline saying that it hits all-time high, right? It starts to break new highs. But then very, very quickly, what happened to price of it is that it starts to reverse, and then came really, really back down, right? The retracement was pretty deep. Not sure how many of you here today did actually fall into the trap of buying at the very, very top, and then kind of have to either endure some unnecessary drawdown period, or have to force to cut losses unnecessary as well. That's really what we call like emotional trading, right? Because you kind of tag along with what's happening in the market, right? When there's a hype, then you jump in, usually it's too late, okay? Or when there's a fear in the market and then you start to panic sell, again, usually it's not the best thing to do, right? So that's where the framework and the system would then eventually come in to really help you on that, right? Now, so why would traders have the FOMO or even emotional aspect of trading? Is because they lack a strategy, they lack a framework, a system to actually help them make decision on a consistent basis, right? And that's where today, again, hopefully by providing you that framework, that 3 steps process, it gets clearer, you can trade with more confidence. Right? Now, obviously, there's no such thing as like 100% sure win strategy out there. It doesn't matter what you trade. Risk management is very important, right? So that's where I also see traders sometimes they over leverage, they get too confident, and they don't put in a proper risk management process, right? Especially in the crypto market when things are very, very volatile. It can go up today by 20%, it can come back down another 10%. The very, very next day, things are very, very volatile in the crypto market. You need to have a very strict risk management approach. You need to know when to get out, when to cut your losses. And obviously, of course, when things move in your favor, how do you then protect and manage your profits, right? Now, of course, just now I briefly also mentioned, right, the crypto market has a specific and unique characteristics where they tend to consolidate quite a bit, for a sustainable period of time, and then suddenly the market would just break out, right? So this is where you need to understand market cycles as well. Okay, depending on what markets you trade, they have their own unique characteristics. So that's something you need to be aware of. Obviously, in the crypto market, then we basically only have 2 big categories, right? What we call the more stable coins, things like Bitcoin, things like Ethereum. And then you have what we call the altcoins, which are more of the smaller market cap, right? Obviously, they do have some correlation. But again, you need to understand the big market cycles, right? Then, of course, news and macro events are also very important. Things like, if you're aware of Bitcoin halving, right? Obviously, we passed that already. The next halving will be sometime in the future. But things like this you need to be aware of, right? Because that can actually shifts some of the macro and fundamentals of crypto market. Okay, things like maybe government regulations, right? Financial regulations that comes in as well to regulate the crypto market and things like that. Moving forward, we'll see more and more of this development. So if you are very, very active in the crypto market, you're actively trading and investing with it, obviously, these are the information that you need to keep track, okay? Because it can impact how the prices move, okay? Now, lastly, of course, you don't want to be over trading or what we call burnout. I do see a lot of traders, really get excited jumping into the 1 minute time frame chart. To be very, very honest, it's not something recommended to be trading on a 1 minute chart in the crypto market, because again of the spread or even slippages issue that you might face, right? So going too small of a time frame might lead to what we call an overtrading aspect, right? Or you might be too stressed out trading in and out, buy and sell, taking a lot of trades within a single day, then that will lead to burnout as well. And then you get tired, you go into a spiral cycle where you make mistakes and things like that, right? So what you want to do, or say by end of today's session, hopefully is you have a proper framework to guide you in approaching the crypto market and beyond that as well, right? Hopefully beyond the crypto market itself in terms of like general trading, if you're approaching the market, hopefully that framework gives you that clarity. Okay, so what is this framework that I'm talking about, right? I call it the DSC framework. It's what I would put it as a universal framework. Okay, why I say universal, meaning that doesn't matter what strategy, what methods, what techniques, whether is it technical analysis, whether it's a fundamental analysis, doesn't matter what it is, right? Your strategy, your trade plan needs to have this three component, right? So that's what I mean by universal. It applies throughout, right? So what does DSC stands for? It essentially stands for direction, setup, and context. Okay. To make it very simple, direction essentially is to determine, you know, as a trader, do you want to be focusing on the buy or do you want to be focusing on the sell? Right. Of course, this can be like different time frames. You can say, okay, in the swing trade perspective on the longer time frame horizon, would the market likely go up or down, right? But at the same time, you can also consider, okay, in the short term, can I trade the retracement, right? Can I trade the sell side of things? Can I trade the buy side of things? The whole idea is direction here refers to having a clear bias so that you can be focused. You know that, you know, if you're doing it on a day-to-day basis, you then know that, okay, today I'm only going to focus on the buy, or today I'm only going to focus on sell, right? So that can give you the bias. So there are many ways you can determine directional bias, right? You can use fundamental, as I mentioned, you can use technical analysis, you can use indicator-based, you can have a combination of few. Okay, so that's where directional bias comes in, right? Now, once we have that, then the next part, the next step in this framework is to have a clear trading setup. Okay, so what I mean by trading setup is essentially the timing to get involved in a trade, right? What price level, when to get in, when to get out, where's your stop loss, where's your target. Okay, what are the conditions and criteria required for you to actually execute a trade, right? Again, there are many approaches. Are you using indicators to help you get involved in a trade? You know, are you looking at price action? Are you looking at multiple layers of confirmation? You know, maybe an indicator combined with price action, candlestick patterns formation. Okay. Again, there are many ways to determine and come up with your trading setup, right? But every strategy, every trade you take, you need to have your trading setup. Okay. So today I'll share with you what are the methods I use for the direction and the setup. To give you some ideas, right? But of course, you might have your own style and your own preference. So you might tweak it. You might already have your existing techniques that you're using. Okay, but hopefully this framework give you that clarity. Okay. And then lastly here is context, which is essentially all other factors to help contribute in increasing the win rate and the accuracy of your trade, right? So context here, obviously, it covers, you know, multi-time frame alignment. It kind of covers if today you're looking at technical primarily, then context can also be inclusion of fundamentals, right? Macro and news. Context can also be the part where if today you're doing a counter trend, right? So how do you determine is a counter trend is actually part of context, understanding the market. So you know that this trade is a counter trend. How are you going to manage it, right? If it's a counter trend, obviously you're going to manage it a little bit more aggressively, more actively. If you're doing a trend following, then obviously you can go for extended targets, right? So again, how you determine all those, it comes from context, right? Knowing the trade that you're taking is based on what, right? Because if you only look at it from a perspective of, oh, it's a trade setup and then you just take it, right? Then sometimes you might not be able to fully capitalize on that particular trade. Okay. So that's where context comes in. Okay. So that's the part where the reason of this framework is not really a strategy, but the details of this framework is where your strategy comes in. Okay, this framework is giving you the big picture, clarity on how you can approach the market. So this is also important because it gives you an understanding of what you need to work on as a trader. Okay, I'll give you an example, right? If today you realize that, hey, every time you take a trade, okay, you realize that doesn't matter what, you tend to get that trade direction wrong, right? Meaning if you buy, the market just goes down all the way. If you sell, the market just decides to bounce higher and then, keep going higher. Then obviously the feedback that you're going to get from your trade, your journal, the market is telling you, all right, whatever method you're using to determine your direction, whether to buy or sell, is not working, right? Because most of the time you get it wrong means you need to work on determining to get the direction right, Meaning you need to then work on the techniques and the improvement on it to increase your accuracy of determining the direction. Now, then there are traders who might face a challenge where it's not really so much of a direction problem, but maybe it's the timing, right? What I mean by that is they might end up getting involved in the buy trade. The market touch their stop loss, and then after eventually touching their stop loss, it starts to go in their direction, right? So if you buy, the market came down, tag you at the stop loss, and then start going higher and then break new high. So you realize that, hey, your direction is correct, but you got in at the wrong time, right? Because if you got in a little bit later, that trade would have been a profitable one, right? So that again is a feedback that the market is telling you, all right, whatever method you're using to determine direction seems to be okay, no problem on that. But you need to then work on your entry setup, right? Maybe you need to fine tune, all right, maybe I'm not going to enter so soon. I want to enter a little bit later when the market pull back deeper, or you want to wait for more confirmation that the market is indeed starting to bounce, then only at buy in and things like that, right? So this framework also gives you the clarity in terms like what are the factors you want to work on. Okay, so this is where it comes. So I'll break down a little bit in terms of the techniques I use within this framework to help me determine the components of it. Okay, so the first one here is directional bias. So of course, as I mentioned, this includes techniques that can be looking at the chart, technicals, can be a fundamental perspective, can be seasonal. For those of you not familiar with seasonal analysis, essentially is basically looking at statistics. For example, for the past 10 years, okay, you realize that, oh, okay, maybe cryptocurrency A or let's say Bitcoin, right, for example, tends to rally maybe in February most of the time, right, based on like past 10 years statistics. Then what seasonal analysis is telling you that February might be a good year or a good month within the year to be looking at buy trades, right? So seasonal analysis can give you the directional bias itself based on historical stats, right? Sentiment analysis essentially is looking at the overall risk sentiment in the market, right? So especially the crypto market is pretty sensitive to risk sentiment. What I mean by that is if there are huge uncertainty in the market, for example, maybe potential war outbreak and things like that, those news, those sentiment may have a direct impact in the crypto market, okay? So you might want to understand a little bit here and there, and then of course decide on what techniques you want to use to primarily determine your directional bias, okay? Now for me, I use technical analysis mostly, and I use more specifically Elliott wave principles to determine the directional bias. Okay, so what I mean by that is let's break down the core essence of Elliott wave. In short, in the chart, if you open up, there are two general movements, right? One is called impulse, the other is called correction. So impulse is referring to markets movement that are very, very strong in momentum, right? So if you translate that to candlestick pattern, it's like huge candle body, right? So that's what we call impulsive move. It can be seen on the lower time frame, it can be seen on the higher time frame. Any chart you open up, any time frame you open up, you'll be able to distinguish that, right? You'll be able to see, oh, this candle body is relatively huge. The market is moving very strong in momentum, so we categorize that as impulse. Okay, now of course the opposite is going to be correction, right? Where the market is basically in a consolidation phase. It's just bouncing up and down, it's in the range. Those are what we call corrective phase, right? Correction, right? So why is this important? Because when you are able to identify how the market tends to move and you identify the patterns from this development, you'll be able to then determine what we call a directional bias, right? Because patterns in the market tends to repeat itself quite consistently. So the idea of this is that whenever we get an impulsive move followed by a corrective pullback, right, which means a fast move followed by a slow pullback, we have a clear pattern and therefore a clear bias, right? If you don't have a clear pattern, we don't have a clear bias. Okay, it's simple as that. So how does an impulse followed by a correction looks like, right? For some of you who are familiar with chart patterns, right? This is not new. It's as simple as some of you might know as a flag pattern, right? You have the pole and then you have flag, right? In Elliott wave, it's just a different name where we call it impulse correction, right? And whenever you see a pattern like that, right, that's where you have a clear bias, because if you get an impulse followed by correction, pullback, then there's a very high chance the market would continue in its previous trend, right, or previous direction. Okay, so that's what we call impulse correction pattern, right? So very, very clearly, if you open up a chart, again, doesn't matter what time frame, if you see a pattern of an impulse followed by a corrective pullback, you know it's a continuation pattern, right? So that's where you establish the bias itself, right? Your focus on it, okay? Now, in Elliott wave, we also another pattern, we kind of simplify the name, we call it a cross structure. Okay, so what does a cross structure looks like is that when you get an impulsive move followed by a slow corrective development in the same direction as the impulse move. Okay, so think of it as initially you have a lot of momentum in one direction and then the market continue in the same direction, but it's losing momentum, right? So when you get something like that, we call it a cross structure, and often this pattern is a reversal pattern. Okay, so how it looks like on a chart, this is examples of a crawl. You can see on the right and the left, on the left, you can see a fast move dropping down, then a crawl, right? Then the market reverses. On the right, you see a fast move going up, and then it's a crawl, and then the market reverses. Okay, so again, identify these patterns, right? Be familiar with it. When you see something like this occurring on your chart, again, doesn't matter what time frame, gives you that bias so that you know what to focus on, right? So if you see a bullish crawl, right? So you see the market on the right pattern itself, right? If you see a bullish crawl, you know that, right? I do not want to be buying, right? Why? Because the bias here is bearish. The pattern is telling me a potential reversal is coming, right? So either I'm going to wait for the reversal to complete itself, or B, I'm going to be more aggressive and look for the reversal sell trade. Okay, so that's where the bias kicks in. It gives you a focus to know what direction you want to be looking out for. Okay, but of course, up to this point, you realize that, hey, we don't have an entry yet, right? That's true, because directional bias, the main goal of it is to really just give you a focus on whether to buy or sell. It's not telling you now, get it, right? It's not. That's where the setup comes in, right? So bias is very, very important. That's the first step in the framework. You want to establish that. Okay, now there are many other patterns, but to be honest, you do not need to overcomplicate the whole process. Okay, for me, I really focus on this. Obviously, with Elliott wave, you can go deeper, but this is the fundamentals of it, right? This is the foundation of it. With this, it's sufficient to help you determine your bias, whether to buy or sell. Okay, now once you have that, when we are crossing into what we call the setup phase, there's this in-between step. Okay, and this middle step is about establishing and identifying your POI, right? In short, is POI. What does it mean? It's called point of interest, okay, or key area. Now, why is this important, right? Because these are areas in which price tends to have a reaction, okay? And these are the prices where we want to look for our trade, okay? Now, so be aware between your bias, your directional bias to your setup, there's this in-between phase where you want to identify where is your key area, okay? So again, there are many methods to identify and establish that. For me, I use mainly the Fibonacci tools as well as support and resistance key levels, right? Again, very, very simple concept, but when you put them together, it becomes very powerful. Okay, so in this example here, that you're seeing is basically what we call a three-wave Fibonacci extension. It's tied to Elliott wave principles as well. In Elliott wave, most of the time when we see a three-wave completion, the market will give you some reaction, and then we combine it with Elliott wave Fibonacci ratios, right? So over here, we are looking at the ratios of 100 to 123.6. Essentially, this is the key area of where the three-wave would complete. Okay, and then on the right, essentially is where you see an example of a three-wave completion, and the market actually reacted off nicely from there. Okay, so that's an example of a three-wave bullish POI, right? So if you flip it, then obviously the bearish three-wave POI works as well. Okay, so you can see on the left is an example of an illustration. We have the 100% to 123. That's the key area. And then on the right is basically an example where price tagged into the key area and gave us a very, very nice little reaction. Okay. Now, the other way to establish using Fibonacci is a simple retracement ratio. Okay, so on the left, you can see that's a corrective Fibonacci retracement. We're using key levels of 50 and 618, right? If you're familiar with Fibonacci retracement, that's the common fit, right? On the right is basically the example of how price actually pulls back towards the 618, gave us a very nice little reaction. Okay. Of course, if you flip that, it's the same, right? Today you have a bearish corrective Fibonacci retracement of 50 to 618. Again, same thing on the right. You can see the market back very, very nicely, hits the 618, gave us a decent reaction. Okay. So again, point of interest is not your entry, right? It's basically an area which we then zoom in and look up for our setup, right? Point of interest is essentially, think of it as those are the areas I want to pay attention. If the market is not there, I'm not interested. If the market enters into my point of interest, that's where I get very, very interested. Okay. Now, this is the part where for me, I use multi-time frame as well. Okay. I use a 4-hour time frame to establish my direction plus identify my key areas. When price enters into those key levels, I would then drop to a 1-hour chart and look for my setup. Okay. So my process is pretty straightforward. On a higher time frame, we look for bias. In terms of direction, we look for key areas, we look for point of interest. When we have a clear bias, when the market enters into a point of interest, I will drop to the lower time frame to look for a trade setup condition. Can follow, right? So once we have those two things established, then the third part here is obviously, identifying your setup. Okay, so you need to be very clear what are conditions you want to see before you execute a trade. Okay, so this is the part where I utilize a combination of SMC, smart money concept, okay, as part of my entry technique. Okay, so very, very quickly, I just show you the model, right? On the left is basically the model of a buy trade setup. On the right is basically the example that happens in the chart. Okay, so there are a few components that we need to see, or I would say a few criteria that we need to see before the trade setup becomes valid. We want to see some liquidity purge, right? AKA that's what we call a fake break. Once we get a liquidity purge or a fake break, we want to see obviously, a break of structure, right? So in this case here, the example is essentially like this, okay? The market came down, break this low, right? And then reverses and break this high. This is the part where we can then conclude this is a liquidity purge because it's a fake break, right? Why is it a fake break? Because it broke it, but then did not continue. It reverses and break the previous high. Okay, so this is where we get a clear break of structure, right? So once we have this too, we also want to look and see if when this market is moving hard, do we have what we call a market imbalance left behind, right? And that's what we call FVG, fair value gap. Okay, now if there's no fair value gap, there's no trade setup as well, right? So this is very, very important. And then all we want to do is once we have these conditions fulfilled, We wait for the market to come back towards our 67 fit. That's our entry. Okay, then of course we have a stop loss, we have our take profit. So if you take a look at this here, you can see this example with this low, the market went up, pushed down, break that low, but after that came back up very quickly. Impulsive as well, very strong momentum. It managed to break this high. It leaves behind what we call a fair value gap, right? So it's a perfect example of a trade setup. Okay, then of course you can see this works beautifully, right? Bear in mind, obviously, not all trades are gonna work out, 100% all the time. There's no such things, but this works about close to 70% of the time, right? So that's the setup, right? If I very, very quickly show you the sell model, it's basically the flip side of things, right? You want to have liquidity purge, you want to break a structure, you want to have the same thing, the fair value gap created. And then you wait for the market to retrace back to 67. That's where you get involved. Okay. So what you see on the right is again example of a real chart. Okay. And then you can compare it with the model on the left, right? So basically you can see side-by-side comparison, what I mean by liquidity, what I mean by break of structure, what I mean by value gap. Okay. Now, for those of you who are fairly new to SMC model, you might ask, how do we identify the market imbalance? How do we identify fair value gap, right? Fair value gap is basically a 3-candle pattern that often occurs when we have a strong candle body. Okay. From any wave perspective, is basically an impulsive move will often leaves behind FVG. Okay. So it's a key 3-candle body, 3-candle pattern. So what is FVG? You see on the left here, we have a bullish fair value gap. You can see that the middle candle is huge, and then the left and right, okay, the first and the third candle did not overlap, right? The high on the first candle and the low of the third candle did not touch it up, did not touch each other, right? So that gap itself is what we call a bullish fair value gap. Okay. So if you take a look at the bearish one, it's the same thing, right? You have a middle candle, which has a huge candle body. The left and the right candle beside that did not overlap. Okay. So that's what we call a bearish fair value gap. Okay. So that's what we call a bearish fair value gap. Hopefully you guys are following through. Okay. So this component is very important because if today your setup, it's lacking a fair value gap, it's not a valid setup. Okay, this is very important. You need to have this component. If I just go back, right? You need to have the fair value gap component to complete your setup. If there isn't, I mean, sometimes the market can, break the structure, but if that break of structure did not leaves behind a fair value gap, it's not a valid setup. Okay, so this is crucial. Right, so I'll show you some example on the chart. You can see that this one here, right, we have a break of structure. Whoops. Okay, this one here, we have a break of structure. Okay, and then we leave behind a fair value gap. So that's what I meant, right? So this one here as well, you can see we have a break of structure, and then this leaves behind fair value gap. Okay, this is important. Again, if this is missing, it's not a valid setup, right? You want to just ignore the setup itself. You don't want to trade it. Now, in SMC, I also want to introduce you to liquidity sweep, right? So some of you might be very new, like what exactly is liquidity? What exactly is liquidity sweep? Okay, to make things very, very simple, is basically your previous highs and lows, right? Significant highs and lows, they are often liquidity points that the market would try and break it. Sometimes it's a genuine break, right? Which is a trend continuation setup. Sometimes you just break it a little bit and then it reverses, right? So if it does that, that's what we call a liquidity sweep. Okay, it's a small little break and then the market just basically reverse, or you can call it a double top, double bottom. Okay, so pay attention to all this component, right? As we go into the live analysis in the market to talk about this, you can see how this are being applied as well. Okay. Now, lastly, I just want to very, very quickly touch on context, right? I did mention earlier as well, context is really all about building the confluences, increasing the odds, the probability of your winning, okay? So things like multi-time frame, things like, are we trading with the trend against the trend? Are we trading the pullback? This are context that allow us, right? Additional information that allow us to know how we want to manage the particular trade, okay? So that's essentially the DSC framework. I want to very, very quickly, show you an application of this framework, okay? So let's say I'll just do an analysis on Bitcoin, right? Which is basically the quote unquote grandfather of crypto markets, okay? To start off, okay, if you remember the framework called DSC, to start off, it's always about establishing a directional bias, right? So how do I do that? I look at a 4-hour chart, okay? That's my kind of like plan, right? That's my framework. That's, I would say, my time frame, right? Because I do a lot of swing trades. If you are more of an intraday, maybe your higher time frame would be the hourly, okay? If you're more of a longer term investor, maybe your higher time frame would be the daily chart, right? So you need to then find the balance from there. Now, so what do I start off with, right? Obviously, if you take a look at this here, okay, if I zoom out sufficiently, I think it's very, very clear. The market is essentially doing a higher high, higher low, right? I mean, we have this low here, we have this high here, the market broke it, went all the way up, did a bit of pullback, went all the way up. That's where the news reported break of highs, all-time highs, and then instantly reverses, okay? But overall, if you look at this structure here, from the Elliott wave perspective, we have this an impulse, we have this as a correction. We are overall bullish, okay, at least from what we're seeing right now, okay? So what we have established over here is we have, okay, if I were to draw in a little bit of things, right? What we have is we have this push up as an impulsive leg, okay, this pullback here, which potentially may have completed itself, okay, and we start to see the market pushing back up, right? Obviously, right now, this is a pullback, right? As of now, based on what we see. So what do we have? We have established this thing called directional bias. At least from a H4 perspective, we are currently holding on to a bullish bias, okay? Now, simple, okay? So once we establish that, then the next thing we want to do is obviously identify where's my POI, where's my key area. Okay, that's why I can zoom in a little bit to get a little bit more clarity. We know that, okay, this is our current swing low points. Okay, the market went up, and then right now it's doing a pullback, right? So a simple key area that I can use is basically my Fibonacci retracement, right? 50 and 618 is where our potential key area is, which I can't talk about it just now, right, using PPT, right? So where we are right now is basically the market is testing our current POI, okay? Or what I say, the market has entered into our key area. This is exactly where we want to start looking out for potential trade setups, right? What's our trade setup? What's our directional bias? We are expecting the market to react and start going back up. Can follow the top process. Why? Because the directional bias is bullish. The market has retraced, has entered our key area. There's a very good chance the market will start to react off this point of interest. What's our bias? Bullish. What is our trade setup potentially we're looking at? Buy trade setup. Okay. So when we establish all this, what we can then now do is we can go down to the lower time frame. Okay, I can remove a little bit of all this drawing to keep things simple. We know that we are already in the point of interest. We know we want to focus on the buy, but do we have a buy setup as of now? No. Okay. But then what is our model to get involved in the buy trade setup? We want to see something like that. Right? Are you familiar? Can recall with this model, right? We want to have a liquidity sweep. We want to have a break of structure. When this break of structure, we want to see a fab at a gap. And then we basically wait for the market to come back towards our 67. That's where our entry point is. So we are very clear what's our setup. What do we need to see, right? So as of now, we don't have it, but visualize a little bit. If the market starts doing something like this, okay, we would then start to see a potential liquidity sweep, a breakout structure over here. If this breakout structure creates some sort of a Fibonacci gap, we can then start to measure Fibs, okay, and look for entry point at 67 and potentially target just this swing high, right? I mean, if you are just without any context of managing your target, you can just aim for something like that, right? The risk reward ratio on average is going to give you 1:2, which is pretty good, okay? But of course, if you understand the context of this particular trade, you might be able to extend your target to increase your risk reward ratio, or having multiple targets you can partial profit take, etc. Okay, so that's the application of the trade setup, right? But obviously we don't have it right now. So what do? You wait for the setup to develop, then you get that potential trade. Okay, now I'm gonna give you an example, right? Let's just say Ethereum. If this two is gonna be the very, very same, then I'll just look at other instruments. Okay, now maybe I'll work on Ethereum a little bit, right? While they're generally the same, I just want to show you that slight details, right? Sometimes these are important as well. You can see that this low here is what we call a key low, right? So this, again, you remember I mentioned liquidity. The market tends to gravitate towards these areas and then try to break it, okay? Now, as of now, we haven't really break this low, okay? But because this is a very, very significant low, there's a good possibility the market will try to sweep liquidity out of that low. And then that's where we can start to find our potential setup. Okay. So why am I looking at buy? Because I think very, very clear, we are basically bullish overall, right? This is where your consolidation is, your corrective phase. This is your impulsive, right? Impulse, correction, continuation. So our bias is there. Where's our key area? Previous swing low. Okay, that's your key area. So when price enters that key area, what do you look out for? You look out for the setup. Okay, pretty straightforward, right? Again, once you get yourself familiarized with this framework, you start to apply it. Start to gain that clarity. Okay. Yeah, so same thing here in LTC. Very, very similar. It's currently testing that. Right. So some of these crypto markets are already in the key area, point of interest. You basically just need to wait for a valid setup to come to you, right? Same thing here. You can see this is Ripple, right? We're kind of there. Let me see if Ripple actually made a bounce out of it. Okay, now Ripple had a very nice hourly bounce off that key level, but we don't have a setup yet. Okay, so if you are really trading the setup, you want to see something like this. Okay, you need to see another liquidity sweep. Now, suppose you don't get it. Okay, suppose the market just decides to go higher from here and then does a pullback like that. Okay, can you trade the pullback here? Answer is yes, right? But then that will be a slightly different setup, right? Which means as a trader, you can have more than one setup in your toolbox. Okay, but again, you can see where the framework comes in, right? Direction, setup, context. You can have multiple setups that allows you to execute trade, meaning you can have multiple entry techniques. Okay, I'm just sharing with you one based on SMC, which is the most common one that I'm commonly using. But of course, you might have your own current existing setups that you're using. You can actually put together. Okay, so something like this can look into, right? To be honest, in general, most crypto markets are behaving more or less the same, right? So you can see here, this lows, those are the areas. This is Dogecoin. Okay, do we have it at the 5618? This one actually go a little bit deeper. It actually went closer towards the 67, but okay, did we react off this key level? No, right? But it's fine because why? We don't immediately buy at our key area. We only start to pay attention to it and look for a setup, right? If the market, for example, come into our key area but doesn't give us a setup, we are not trading, right? Just to be very clear on that. Okay, now, so if this blasts through the entire key level and there's no reaction, what can you expect from here? Okay, where is your next key level? Previous low. Okay, meaning based on Dogecoin, right? Either you can start to look for maybe short-term potential sell in anticipation that price will come and tag this low. Okay, and then only bounce. You can look for short-term sell. Okay, so again, this is context, right? Now, understanding that my whole bias is bullish, but in the short term, if there's some room of opportunity that I can capitalize while it's pulling back, I can potentially also take some trades, right? So those are basically what we call a retracement short-term trade. Okay, so the context of those is basically you need to be a little bit more active in managing those. You need to maybe make a decision on your risk management part, right? Because it's a counter trend, because it's a short-term retracement trade, you want to take a smaller risk and things like that. Okay. So hopefully so far so good. You guys are following through. Okay. Yeah, so basically, that's the gist of the framework. Okay, the DSC framework itself, direction, setup, context. We briefly, very quickly went through some of the application on the live markets, right? Definitely some of the major coins here, you can see we are in a key area. You basically just need to wait for a setup, or if you already have your own setup, by all means, right? I think it's a good level to start focusing on potential opportunities moving forward. Whether you get an entry or not really depends on the setup itself. Okay, good. So from here, I think we'll jump to the Q&A segment to see if you guys have any questions that you want to clarify, regarding the content that we went through, or maybe, some of the questions regarding certain crypto pairings or currency coins that you want to look into, right? Just feel free to put it into the Q&A tab. Good. Cool. So far, at least from my end, I don't see any question coming in yet. If you guys have any, I think now is the best time to put it in, right? So we can do our best to answer your questions.
Hello, Mr. Yang. I got one question from the back.
Oh,
and
okay.
The first one is about beginner traders. In your presentation, you mentioned that emotional trading, over leveraging, and ignore the macro events as common struggles. So, from your perspective, which mistake do beginner traders most often fall into, and why?
Okay, good question. I think the most common challenge or mistakes that beginners traders will fall into is the hype of entering into trade, right? So basically sliding towards what we call over trading. The whole idea here is a lot of times traders have a misconception that, the more trades you take, the more profitable you're going to be. The more trades you take, the more profits you can make. Or basically they have the understanding that the term trading equals to, I need to be in the trade all the time. Okay. That's not entirely true, right? Because the more trades you take, you actually opens up the possibility of making more mistakes as well. Sometimes if you are forcing yourself to take unnecessary trade, then it might not be the best trade possible. The more trades you take, or the more trades concurrently that you're holding, you also need to understand that the more energy you need, right? The focus you need to actually look at all of them, right? To manage all of those positions. So a lot of times all this misunderstanding leads to unnecessary losses. that beginners traders may kind of commit, right? Because they come into the market not really knowing or understanding, what it is, right? So they only have the idea that to make money, I need to trade, right? And then they go into one trade, they start maybe losing from there, and then they will fall into the next cycle of, I want to make back my losses, right? I want to cover my losses, and then they'll start to take more trades, right? And then it becomes a very, very spiral cycle where the more trades you take, the more mistakes you make, the more difficult are you to overcome, and then the more you go into the aspect of, I want to, revenge trade, right? And then that cycle basically is there, right? You keep repeating it. Yeah, so be aware of it, especially if you're very new. I would say, start understanding the core of the markets and the framework that I provide you guys. Start from there, so you have at least some guidelines to help you be disciplined in approaching the market.
Yeah, maybe first to learn and analyze, and then into the new real market.
Yeah.
The second question is about the SMC trading model you mentioned. It's about FVG and liquidity to get into the market. So he wondering, how does this approach differ from the traditional technical analysis, such as moving average or MACD that are very commonly used? What's the main advantage of using SMC strategy?
I think the main difference obviously is one is price action based, meaning we look at price combination patterns, right? So things like candlestick formation, Fibonacci's, to help us determine the criteria to execute a trade. And then of course you have the indicator base, which is, I would say, a little bit more on mathematical calculation base. Now, at the end of the day, there isn't the part where like which one would be better. I mean, each has its own unique strength and of course weaknesses. But in general, if you are using indicator base, usually it's a technique where you need to some sort be in front of your computer to execute a trade, right? So for example, I'll give you a very simple one, like if you're using an MA crossover technique, right, or setup that requires the MA crossover, and then you get involved in the trade. You can't really use what we call a pending order, right? You need to actively be clicking on the buy or sell button when the MA crosses over and then it fulfills a condition, and they need to be in front of the computer, click buy or sell, right? Yeah. But if you're using a certain patterns and based on SMC model, the setup allows us to use what we call a pending limit. Meaning, if all things are fulfilled, I'll be waiting for the price to pull back towards my Fibonacci entry area, right? So I can actually place what we call a sell limit or a buy limit, where if price actually retraces and tags the area that I want to get in, the order itself can be automatically be executed, right, based on the pending order limit. So I think that's one of the main difference between indicator-based strategy in general, versus I would say a little bit more towards like, price action and things like that. So again, it's a personal preference, personal choice. For me, I use a lot of pending orders, right? Since I started, I explore a lot of pending orders technique, right? That's how my preference is, right? And that's where it's something I like. So that's where the development of techniques and strategies eventually would gravitate towards, that style of entry. Yeah, so I think that's really that gist of like, different techniques would have slightly different styles, pros and cons as well.
Thank you, Mr. Yang, for your insightful presentation. And I think everyone is really engaged in it. So
Yeah, all good.
good. So if you have further questions, you can still leave. Okay, we got one more question here from Elmarie Navarro. Whenever there is a FVG, do we expect to pull back the price most often to fill the gap entirely or just partly? How many percent?
Okay, good question. Most of the time it will get filled. But obviously, you know, there's no 100%, there's no certainty, like 100% certainty in the market. So again, this part here is something you need to be aware of as well. You don't want to just trade off fair value gap, right? Because not all fair value gap is of equal importance. You need to have different elements, you know, coming together to give importance to that fair value gap, right? That's the part where a setup itself is not just, oh, you see fair value gap, and then when the market pulls back towards a fair value gap, you just trade it off it. Okay. That's where the framework also kicks in, right? So most of the time the fair value gap will get filled, right? But you do not want to buy or just sell every fair value gap, right? If you take a look at charts here, if I just drop to the hourly, right? You'll be able to identify fair value gaps from most movement of the chart, right? You can see here we have this fair value gap where the market reacted off it, you know, and then after that it breaks through it as well. And then if you start looking at this, we have here fair value gap as well, which the market kind of like reacted off it, but then after break it as well, right? You have a fair value gap here as well, which totally does nothing. Okay. And then of course you don't really see much of a fair value gap as this continue to develop, and then you have like fair value gaps here. Okay, so you'll be able to identify FVG throughout. Okay, but bear in mind the strategy, the setup is not about fair value gap. Okay, the setup is a combination of few conditions and criteria where fair value gap is one of the very important criteria that needs to exist. Okay, so the understanding is very, very important. Because I get a lot of traders misunderstood it as, oh, we are trading fair value gap. Right? We're not. Fair value gap is a very important element that needs to exist within the setup itself, but we are not primarily trading because there's a fair value gap. All right, so bear in mind, most of the time it gets filled, right? To answer a question, like for example, okay, this is coming down very strongly. There are fair value gaps created here as well. Will price likely get it filled? Yes, right? But will it always react and bounce off? Not necessarily. Okay, so hopefully that's clear.
Thank you, Mr. Young. That's very well said. And does anyone has few questions for Mr. Young? Maybe just pop into the Q&A section. Okay. Thank you, Mr. Young. Maybe I can stress the special promotion for today's webinar.
All right.
Thank you. Well, for all the guests join us tonight, if you register through the link from the chat box, and you could get into this lucky draw promotion and deposit more than $250, you will have one entry. Have the chance to win Brooklyn Net game, Blackpink World Tour tickets, and more. For Southeast Asia clients, we also provide credit promotion and phone promotion. And if you join the Telegram chat, and you could have $10 cashback and so on. And most important, if you register today, I will get in touch with you shortly and to explain all those promotions for you. So maybe it's a good time to join TMJM today and create the account here. Okay. Thank you everyone for joining us tonight. And thank you, Mr. Yong, for sharing this insightful strategy, and hope everyone find today's webinar useful. And thank you again for joining us tonight, and good evening. And looking forward to see you guys next time. Good night. Good night.